Okay, so good morning, everyone. Welcome. I've got the poll going, and today we've got 4 happy, 3 excited, 4 okay, 2 meh, and 1 sleepy. That's not too bad. Usually in the other lectures, I've got a lot more sleepy. So welcome, everyone. And so this week is our financial statement analysis and accounting policy choice. And I'll just briefly sort of show you, where we're going. We've got 2 more weeks of lectures after this. And so we're now in a distinctly different phase. We did have financial, external report in terms of preparing reports for use of external users, so under the accounting standards. But now we're entering this decision-making and managerial reporting phase. So we're external to the firm in this week financial statement analysis. We're trying to make a decision. Should we invest? Should we buy? Should we sell the shares? That kind of thing. So we're using what we've prepared in the previous weeks as an input into this analysis. Then, so next week, we're going to be preparing internal management accounting reports for managers to make decisions. And we're going to be inside of a factory. So we'll be going from a manufacturer perspective. And so you'll see a factory behind me in my picture, and you'll be able to try and guess what does that factory make. So we're very much now, this week and next week is about making decisions, supporting decisions with some information, some numbers. Then in week 10's lecture, it's the future of accounting. And so the first 1 hour is a panel talk. I'm going to get some professors, experts in their field, hopefully some alumni as well. I've invited some recent graduates who are working in the accounting profession to tell us where accounting is going in the next 5 to 10 years. That's the first 1 hour. Then the second 1 hour is me talking about the final exam, some tips how to get prepared, and I'm going to demonstrate some past exam questions for you as well. Okay, so that's sort of just so that you're aware we're shifting gears. We're now going to decision making. So you'll notice a change, and then so next week in the factory, week 10, future of accounting. So here we go, financial, and really we're picking up from 1A in terms of the financial statement analysis, and then building onto it and looking at accounting policy choices that will have an impact into things like our ratio calculation. We're not going to really backtrack over how to calculate the ratios. We're going to be building on top of it, and you're going to be learning how to communicate about those numbers, to interpret that information, because that's a really important skill if you want to become a professional accountant, is working out how to build a story about a number, how to communicate. So not just crunching the numbers. So there's much more. Accounting is a role of communicating. So there's the textbook readings. And so what are we going to do in this lecture? Here's our learning objectives. So we're going to start off, we're going to do a little bit of revision on the ratio analysis. I'm going to show you a ratio list, which you're going to have in the final exam as well. I'm going to introduce you to a new type of analysis known as common size statements. We're going to be aware of uses, and advantages and limitations of financial statement analysis and ratios. So it's important to know the weakness of a tool if you're using it. We're also interested in how do choices in terms of things like our accrual accounting, how we measure our revenues and expenses, how are they going to impact on this financial statement analysis as well? What's the effect if a company switches or 2 different companies use different accounting policies? Also then lastly, we're going to look at that there are some incentives for managers to manipulate. So we have to be aware of those incentives and what to look for, what to be aware of. So we start off, so financial statement analysis, it's about looking at the the financial statements of a company, but understanding really the context. So numbers don't exist in a vacuum. They have a context in which they sit. So we need to be aware of that. So it could be, for example, the particular time period. So let's just think about like a debt to equity ratio, how much debt financing a company has. So it could be, let's say, if we were in a pre-2008 world, really high amount of debt. So like if 70% of the company's funding was from debt rather than from equity, we might think that's okay. Like very high levels of debt would be seen as maybe being normal. But in 2008, we had something that we call in Australia the global financial crisis. It started in the US, where they call it the financial crisis. Only other countries other than the US call it the global financial crisis. And that's because there were ripples that went around the world following the subprime crisis in the US. So post 2008, post the global financial crisis, there was a lot more skepticism about, how stable is that company if it's carrying a lot of debt on its balance sheet. So we started to reevaluate, and we started to think, well, maybe having a lot of debt is not very good. It's very risky. So in a post-global financial crisis world, higher amounts of debt are seen as bad, and so a high debt to equity ratio, well, with lots of debt versus equity, it's not good. So there's that kind of context. It's important that we think about those numbers being as part of a system and being generated from the underlying economic processes of a company. So there's no point just going, okay, the debt to equity ratio is 0.7, job done. That's your job is sort of starting with analysis, and that's where we're going with this lecture. So it's not just calculating that number, it's providing an interpretation. So make sure you understand the context. Where's that number coming from? What industry is a company in? What kind of decision are you trying to make? So this will build context around those particular numbers that get generated in our ratio analysis. So in terms of who uses the financial statement analysis, so it's important that we do have a perspective of a stakeholder that we adopt when we're doing our analysis. And these particular stakeholders are looking to make decisions, and the financial statement analysis is a tool to help them do that. So managers, they want to measure, because if you can't measure something, you can't manage it. So they'd be wanting to measure what's happening inside the company, measure the performance of the company, and see, does that align with, the expectations, or, how can they improve? So they'd be looking to use that, and then it'll help them make some strategic operational decisions based on those ratios. So they're looking to measure performance, measure financial stability, so that they can better manage the company. So the investors in financial, so like stock market analysts, they're a very obvious stakeholder group who's interested in doing some financial statement analysis. They want to make decisions. Should they invest in the company? Should they, and the analysts want to issue a buy or a sell recommendation on shares. So they're quite interested to do this analysis to help them to answer those questions. Creditors, they're looking, maybe they want to see if they should lend to the company. So loans, bond holders. So if there's a bond raising for the company, they want to see, is the company capable of repaying? So they'll be looking at those ratios. Also, lots of bonds come with like a clause in them, which is called a debt covenant. The debt covenant restricts the managers from issuing too much debt, because then if they have too much debt, they potentially can't repay. So we would need to, as a creditor or bondholder, be watching particular ratios that the debt covenant is based on. So for example, it could be a debt to equity ratio that's a maximum amount, and if they exceed that maximum amount, it means that the debt covenant is breached. So it could be like, so a 5-year bond, if its debt covenant's breached, becomes due and payable in 1 year. And you can tell that's going to create a lot of financial distress for the company. If something they expected to pay over 5 years is they have to pay it in 1 year. So auditors are interested. Auditors their main job is to check that the financial statements of a company are a true and fair view, that they're in compliance with the accounting standards. But they're looking for information to help and check whether there's any errors or whether those financial statements are reasonable. And also they have to issue what we call a going concern opinion. So going concern means healthy, not going concern means not healthy. And they would be interested to see if there's certain ratios that look unhealthy, which may cause them concern to issue that the going concern opinion. They'd be looking as well at does this company have bonds? Does it have debt covenants? Is it close to breaching the debt covenants? Because that's something that would definitely change their opinion about whether that company is healthy or not. So they're interested in those ratios, and then they can dig down further and maybe investigate for if there's anything that's an error or anything that's a concern. Suppliers are also interested. Maybe they want to supply to this company. They're trying to check out, is it a good company? Is it stable? Are they able to repay their existing suppliers? Or if they are a current supplier, are they going to get paid the money? And as we saw last week, so the longer it takes a company to pay its suppliers, the longer it stretches it out, it could be the less likely that they're going to get paid. So the suppliers would be checking for that. And it could be the company has that really high market power though, like I said, like Woolworths, because we have a duopoly in Australia. We have, two big players of Coles and Woolworths as supermarket chains. And Woolworths is able to, command that market dominating position over its suppliers, and it's known to negotiate very strongly, and it can have up to 180 days to pay the suppliers. So, they can get quite favorable terms with suppliers. And I'm going to add on to this list because I know there's lots more stakeholders, but I thought, I know I'm evolving these lecture slides over time, as you can, and so next time I would probably put employees down the bottom here as well. So employees, if you're going to get employed by a company, you want to check that they'll be able to pay you your salary. And also it's really good to, in a prospective job interview, be able to say that you've looked at the financial statements and, and also conducted some financial statement analysis, had a look at the ratios. And you can really impress people in a job interview if you're going for an interview at a company by just saying something about that particular company that you know about. Maybe you've seen they've done a merger and acquisition, it resulted in some goodwill on the balance sheet. If you tell them about that and it sounds like you've really taken an interest in the company, can put you in a competitive advantage. Also, just knowing something about what's happening with companies generally out in the business world, that's going to really hold you in good stead when you are on the job market. So before we start conducting financial statement analysis, we need to first learn about the company. So companies, the numbers that they generate in their financial statements, they're not in a vacuum. They are part of an underlying economic process. So you need to just start doing a bit of research about a company and thinking about, okay, let's have a look. What's this company do? What industry is it in? Because otherwise, if you just randomly pick a company and you pick another company, you could make some errors. You could make some judgment calls that maybe is not supported by the information. So it's important to learn a little bit. You don't have to learn everything about a company, but to know enough to know, things like what's their industry, what's their strategy. And so I can give you an example of, okay, let's say we wanted to analyze Ferrari, which is a car manufacturer, and they're Italian. And then I just thought, okay, I'll just get another Italian car manufacturer, which is Fiat. And then I'm like, okay, I'm going to compare them because they're both Italian companies. They're both car manufacturers. It seems like I have a good match. But I need to actually learn something about the companies. So Ferrari is a luxury car manufacturer. They make sports cars. And so it's going to have they're going to have a different strategy. They're targeting a different market compared to Fiat. So Fiat makes reasonably priced cars, so for the average consumer, and also they make tractors. So in Italy, farmers often have a Fiat tractor. So you can see I'm going to run into problems if I start to think that Ferrari and Fiat are the same. So I need to think about that. I need to go, okay, what do I expect that will be different? So Ferrari is going to sell a smaller number of cars, but they're going to be at a higher amount of profit per car. So that's going to change my view. Whereas if I looked at it, the ratios, I go, well, Ferrari has a very low asset turnover and has a very low inventory turnover, so it's bad. Compared to Fiat, Fiat's got a very high asset turnover, very high inventory turnover. So you can see I'm making a mistake. I'm kind of going, I'm making a judgment if I don't have that information that Ferrari is luxury car, Fiat is average car. Then I could do it on the flip side as well, where I could go, okay, so Fiat has really low profit margins, really low gross margin, and because they're selling high volume, but not much margin. And then I look at Ferrari, and I'd go, well, Ferrari's doing a lot better because it has really a high profit margin. But that's because it's targeting the luxury end of the market. So you can see I can fall into a trap if I don't learn about the company itself. So you need to make sure you do learn a little bit about the company before you launch into your financial statement analysis. Also, we make financial statement analysis with a decision in mind. So we don't just do it for fun. Like sometimes you could just be looking at shares on the market and looking at different companies and thinking, oh, maybe I should, I'll just have a look at Apple. What's Apple up to? But it makes it much more powerful if you actually are thinking to invest or not invest. So you might invest in Apple, maybe buy some Apple shares, or maybe you're going to lend to Apple, that kind of thing. So we start with a particular decision in mind in our financial statement analysis. That will then help us to target, based on that decision, what ratios are relevant. So if we're thinking, well, to invest, how profitable is this company? How good is this company in terms of generating profits from its existing assets or using its equity? So the decision leads to which ratios to calculate. We don't need to calculate the whole suite of ratios every time we do a financial statement analysis. So then what we do is we've got our company, we've got our decision, and we've chosen some ratios from a ratio list. What we're going to then do is need to pick up some comparative data. So it could be that we need to get some past data. So it might be we look up like 2 years or 5 years past data. Then that's going to give us some trends, because a number doesn't exist in that vacuum. It may need benchmark data. We need to say, well, is it going up? Is it going down? Also, then we need to maybe match with a competitor. We can match with an industry as well. So many, websites like So Google Finance, Yahoo Finance provides industry benchmarks. And this is especially useful if a company is difficult to match. We can always match it to like an average of that industry. If, for example, we've got like Woolworths, we might just match it to a retail industry, something like that, and then compare that performance. Make sure you make a comparison make sense, just like my Ferrari and Fiat example, that we're going to see there's differences, and we might want to match Ferrari to another luxury car manufacturer. And in Wednesday's lecture, there was a student who actually said, well, Fiat owns Maserati. So if we were able to get the Maserati segment data, we could match it to that, or we might match it to Porsche or, another luxury car. Whereas Fiat, we try and match it to an average price car. Maybe if we wanted to stay in the European market, we might match them with Citroën, or if we wanted to go over to the US market, just like on this slide, it could be General Motors, it could be Ford, more of an average price car manufacturer. Also, have to think about, what areas in the supply chain is the company involved in? Are they a manufacturer solely, or a manufacturer and a retailer? So they think about what areas in the supply chain are they in. So Apple is both a manufacturer and a retailer, and also they distribute their products to other retail stores like JB Hi-Fi and Harvey Norman. So here we've got this. It's a very bad match here, but it's just to make the point. What if we wanted to compare UNSW, the university, with General Motors? So obviously that's not a very good comparison. We want to have similar basis comparison. So UNSW, we'd want to compare it to another Australian university because it has the same operating conditions. So we could compare it with University of Sydney or one of our big rivals, University of Melbourne. So then we could check that comparison. General Motors, you'd want to compare it with another car manufacturer, maybe Ford, something like that. Or Chrysler, you want to compare it on a similar basis. So that's the demographic, the strategy as well, as I was saying, the luxury versus more average kind of market, similar goods and services. So for example, Apple, we might think, well, okay, Apple manufactures and sells mobile phones. Let's just find another company that manufactures and sells mobile phones. So we could then see that, okay, there's BlackBerry. BlackBerry makes mobile phones as well. They used to be very fashionable. I think 5-10 years ago, everyone who was a business person, they were to carry a BlackBerry, but they've been they were overtaken by Apple. But the problem is that's not a great match in a way for Apple, because Apple doesn't make just the phones. It makes iPads, desktops, laptops, and even it goes into the intangible product lines of like music, the iTunes store, and also they've launched their own TV channel. So you need to look at maybe a company that has sort of a big portfolio that's going on. So maybe Google. Google makes the Android phones, but also it has its own intangibles as well, like its search engine. So you want to try and make as good a comparison match as possible. Sometimes it's not always possible. That's why we could default to an industry benchmark. But you have to be giving some thought to and some research as to what's a good comparison, what's a good match. So then when we're doing our financial statement analysis, the financial statements are really just the start. So it's important that we also include non-financial information. So financial statements are often only issued on a 12-monthly or a 6-monthly basis. So they're not frequent enough, or in the US they do release quarterly earnings, but maybe it's just not frequent enough for us to get that extra information that we need. So we need to broaden out our financial statement analysis to include more sources. So we need to look at maybe some newspapers, maybe some information that's generated by the company itself. So they put out press releases. You could just search generally on the internet. And in a lecture earlier this week, a student was saying, well, how about a rumor website? So they know about a particular rumor website where it can be insiders or stock market analysts put up rumors that they've heard about a particular company. Well, yes, you could use that in your analysis, but those particular websites plus other sources of information and even information from the company itself, you need to filter it through a bit of a, a lens of like, is this real information? So always critically evaluate the information that you get. And so in particular, the rumor websites, you'd want to be asking yourself, why is an insider saying this? Is this real? Or why is a financial analyst giving everyone this information? Why are they doing that? They could just make money off that information. So just be critical and kind of value judge it. Even information from a company, you have to kind of say, well, is this company putting the information in the best light possible? And so there is scrutiny on what companies will issue in terms of information, but they can try and make the best possible light of information. So even like in a headline, they could try and highlight particular numbers, or they could highlight particular trends. And so we can see that you have to critically evaluate all the information that you get. It could be economy-wide factors. So obviously, right now we've got COVID-19 is impacting every sector of the economy. But and in particular, airlines very much impacted. But before the COVID-19 crisis, the airlines were subject to lots of economy-wide forces as well. So for example, like oil prices, the fuel prices for making the airline fuel, they were subject to those prices. That's one of the biggest components to their operating costs. So every time if the fuel price went up, then their cost goes up, fuel price goes down, their costs go down. So airlines are very much subject to those outside forces. And we can see right now that external forces can impact the companies, and also that the financial statements are not timely enough. So the COVID-19 impact in the financial statements won't be revealed until much later on. So for Australia, like the 30th of June is our balance date, but companies have a 3-month window to issue their financial statements. So we won't see the financial statements come out until September, or sometimes the companies may delay. So it may not be until October, November that we see the financial statements for Australian companies. So it could be other information about other companies. So we can see this where like competitors in the market, they're taking market share. So news about one company can impact another company. So let's say one mining company has a flood, all their mines in a particular country get wiped out. That means that the other mining company, let's say, can take that market share away from that company. So so bad news from one company can be good news for another company. Or it could be like Apple. Let's say Apple releases so in September they're planning to release their next iPhone. Maybe it's an amazing iPhone. That's going to impact Samsung. It might take some of Samsung's market share. So we need to check their competitors. What are they doing? Good news can be another company's bad news, or bad news can be another company's good news. I'd add in here down the bottom as well, like I'm going to add into this slide for down the track, something that's interesting is that companies are increasingly using social media to get their information out about their company. So they're using social media channels like Twitter, LinkedIn, and Facebook to communicate with potential investors and with customers. So this is a new sort of relatively new channel that we're seeing companies much more giving that information there in social media. So for example, I was on LinkedIn the other day, and I was scrolling through, and then I saw, okay, Fortescue Metals Group, they're an iron ore mining company in Western Australia, and they had just announced they're in one of the world's top gender proactive companies list, because they have a female CEO and a female CFO, so Chief Executive Officer and Chief Financial Officer. So that's the company's disclosing information. They're trying to maybe signal to investors we're gender friendly, and it's very unusual to have both a female CEO and CFO. And with that social media as well, there's increased scrutiny by regulators. So in the US, the Securities and Exchange Commission, the SEC, and in Australia, the Australian Securities and Investment Commission, ASIC, and the Australian stock market, the ASX, they're all scrutinising now social media releases by companies to make sure that they're not misleading, to make sure that they're timely disclosure, disclosing to the market appropriately. So social media, I think, is going to be an interesting space in the future, and we've seen a lot of accounting research now looking at those social media disclosures. I think it's quite interesting. Where is that research going to be going in the future? So in terms of financial statement analysis here, I'm going to introduce you to introduce you to a new tool which is called common size statements. And then I'm going to revise with you some ratios, and then we're going to build on top of what you learned in 1A, and we're going to look at interpretation. So we're basically communicating about the ratios. And if there's any questions so far, feel free to write them in the chat box. And let me know, and let me know any questions that you have. Okay. Okay, so common size financial statements, these are really good ways of recasting both the income statement and the balance sheet to be in percentage form. We use particular bases as to be like the baseline, and for the balance sheet this is assets, so total assets, whereas the income statement, it's revenues. So then everything gets is a numerator, and these are our denominators for our calculation. It's a way of removing size differences. So if we had two companies we wanted to compare that are different sizes, it can help us to do them on the same basis. So it removes all the size factors. So let's say if we wanted to compare Starbucks, which is a global chain of coffee stores, and it's got thousands and thousands of coffee stores around the world, so it's a very big company. Let's say we wanted to compare it to Gloria Jean's, which is an Australian coffee chain. I think it's only got around 100, almost 200 coffee stores, versus Starbucks with thousands and thousands of coffee stores. Let's just say we wanted to compare them. We could do this with common size analysis here, because we are removing that scale. So if Starbucks is in, millions, billions, whereas let's say Gloria Jean's is in the thousands, we can do that. We're able to remove any scale and then look and make that comparison, because they're both coffee store chains, but Starbucks very big, Gloria Jean's very small. So it could be that we want to compare over time or different sizes. Also, so it's going to reveal trends, and it's very useful. We can see, okay, over different periods of time, and the company itself might change in size. So companies are often restructuring, or they might do a merger and acquisition. They might merge in with another company, so that's going to change the size, but the common size is going to remove that out. So let's take a look at, here's an income statement. So this is an income statement in dollar amounts. And then what we've done is we've transformed it into this common size statement. So we've taken the sales to be the denominator. So that's 100%. And then everything else in the income statement is divided through by the sales. So now we have this ability to compare between the years, or let's say if this is Starbucks, we could pull in Gloria Jeans, do the same common size analysis and have now this equal ability to compare. So let's have a look. We can see, some good trends that this common size analysis enables us to do. So for example, okay, cost of goods sold, that's all of our costs involved in like making a product or buying a product. It's just that core to actually selling that product. So we can see that it's increased a bit. So, that's something they should keep an eye on. So perhaps maybe the cost of supplies is getting higher. Maybe it's a fuel price of, if you're an airline, the fuel price would be going in there. So then our gross margin, which is just our sales cost of goods sold, we can see, oh, okay, it's declining. Selling and admin, that's external to making the particular good or to purchasing that particular inventories. So these is very much discretionary expenditure in a way, and so it can be things like advertising or office salaries, that kind of thing. So it's a bit more peripheral to making that particular good or to the service or whatever the core product is. So you can see, well, it's increased by, roughly around 3%. So that's not a good trend. So if I was a manager and I saw that, I could go, oh, okay, maybe, for that same amount of generating revenue, maybe we should cut back on advertising. Maybe we had too much advertising, something like that. So depreciation is stable, and you wouldn't be able to tell that based on the dollar amounts. So you can go, yeah, okay, it's the same sort of proportion given the amount of revenue they're able to generate. And you can see that, okay, the operating profit before tax, which is also known as net profit before tax, well, that's decreasing. So that's not good as a percentage of revenue, but you wouldn't be able to see that in just the dollar amounts. So that would actually look really good, going from 675 to 812. So you go, oh, that's good. But here you can see in the common size statement, not really good as a percentage of revenue. And it is to do with those costs. The cost of goods sold and the selling and admin is going up. So you can see the trends that we can unlock. We could do this with the balance sheet as well, where we use total assets as our base. So we're going to track back over the ratios. I'm going to talk about some particular analysis, some trends, remembering that you covered these in 1A, and we're actually going to give you a ratio list, and it's inside the slides. It's going to be on Moodle as well. It's going to be inside your exam, and you can have a look at the Term 1 final exam on the Moodle site, and you can see that it's just embedded there as a particular tab, and you click on that tab and all the ratio list opens. But also the exam is open book, open internet, and so you could have the ratio list open on your computer, or you could have it as a physical paper copy, so you can have that ratio list with you. So these particular headings, these are all consistent with our ratio list as well that we provide you. So it talks to, what particular decision are we trying to make? These particular ratios are going to help us. So we're interested, can they generate some profits? How good is the company's management at doing that? How good are they turning over their assets and also their debtors and their inventory? How quickly can they generate cash out of those? How liquid are they? So if in the event of a collapse, how quickly can they convert, and cover their current liabilities and, convert inventories into cash, cover everything. And then also the structure. Where do they get their finances from? Is it from debt? Is it from equity? So here we've got some advantages of ratios. So the first one, they're scale free. So because we're dividing one number by another, we remove like thousands or millions or billions out of the equation. So we can compare companies that might be of different sizes and compare over time if the company is changing. Also, they're currency free. So once again, so let's say we've got that numerator and the denominator, we're dividing through. If we wanted to compare Qantas with Singapore Airlines, the ratios enable us to do that without any of the currency. We don't need to convert Singapore Airlines into Australian dollars. We can just go, okay, let's say for the current ratio, let's put the current assets in the numerator and the current liabilities in the denominator. So for Qantas, let's do this. It's got Australian dollars in the numerator, Australian dollars in the denominator. So it's cancelling out that currency. And also Singapore Airlines. So current assets, Singapore dollars, current liabilities, Singapore dollars. Divide them both through, but we remove that scale of the currency. So no need to convert across foreign currencies because the ratio is already doing that, dividing one number by another, removing the currency. So now I'm just going to touch on some of these like different ratio categories. This is just really to refresh your mind, and at any time you can go back to our ratio list as well, and you can always go and have a look and go, okay, what's that ratio about? We're not testing you in 1B on how to calculate ratios. We're much more interested in how to analyze and how to communicate about those numbers. So this is quite a distinct shift from what we've been doing previously of lots of calculations like in cash flows. Now it's about you talking about a particular number, interpreting that number. So I'm just going to refresh your mind. So we've got ROA, ROE. And so, how good is the company's managers at generating profits off of the asset base or profits off of the equity base? So, can they generate returns, and how much can they generate those returns measured by these two ratios? So the profit margin, gross profit margin, there's that profitability, and a really important input into both of those ratios are our costs. So gross margin is very strict, just cost of goods sold. So the core product, so where do they get their product from, their raw materials, all those direct inputs are going in there. Versus the profit margin is not just cost of goods sold going in there, but also admin, selling, those peripheral expenditures. So the difference between the two is really that extra component of operating expenses. So activity ratios, so how good is the company at, turning over those assets and, generating revenues or cash out of them. So overall, all their assets. Then more specifically, inventories. And as I said in last week's lecture, you want to be, as a company, turning over the inventories regularly. You don't want them to be building up because they could become technologically obsolete or fashionably obsolete. And that makes it harder to sell them. You have to have something like an 80% off sale just to get rid of them. And we had a chat about this in Wednesday's lecture, and because one student was saying, well, what about Ferrari? Ferrari is going to have a very low inventory turnover. And I said, well, yeah, that's okay. And then, because you know what Ferrari's strategy is, it's a luxury car seller, you're not as concerned about that as you would if, let's say, Woolworths had a low inventory turnover where it's got perishable goods like the milk and the fruit and vegetables. You'd be wanting them to turn over quite quickly. So knowing something about the industry, knowing something about the company strategy is really important when you do look at these ratios. And then also in Wednesday, we had a little nice chat about, luxury manufacturers like Louis Vuitton, and, how do they ensure that, like, they have these luxury products, but what if they have too much of that product? What happens to it? And I was talked about, yeah, that they're getting the Louis Vuitton and other luxury manufacturers are getting under fire from countries like the European Union who don't want to see waste. They don't want to see clothes being destroyed that are still good clothes. So it is a point of contention, you know, where does the excess clothes go if they don't sell them? I think companies like Louis Vuitton want to maintain a really high price. And I gave everyone a tip, eBay. So if I want some luxury clothes at a reasonable price, I'll jump onto eBay. So there are channels that luxury retailers will use to get rid of their unfashionable, you know, fashionably obsolete clothes. So what about accounts receivable? And I mentioned last week, the longer it takes your customers to repay you, the less likely they're going to do that. So they become bad if it takes them a very long time to pay. So you want to see a company turning over their receivables, or otherwise known as debtors, on a good basis. Otherwise, they should reevaluate the credit terms that they offer. So they should go, oh, maybe let's just switch to cash for a while, or try and speed up that collection. So liquidity ratios, this is really, you know, can they pay their short-term debts? How quickly can they do that? So current ratio, current assets over current liabilities. And I just want to tell you that just on this ratio alone, there's now a new school of thought, a modern school of thought, that maybe a current ratio of 1 or less is good because of leveraging off of suppliers. Whereas our old view was always 1 and above is really safe. But so you can see that we're changing maybe our thinking. So for particular companies, it might be a healthy thing if their current ratio is less than 1. Let's think about Woolworths. So they're a market dominator. There's a duopoly in Australia. Coles and Woolworths are the majority of our retail, like supermarkets, grocery stores. So Woolworths has this ability to negotiate with its suppliers because of market dominance. So it can have that 180 days, so up to 180 days to pay its suppliers. So Woolworths is able to leverage off of its suppliers. So it's using other people's money. It's using the supplier's money as a short-term credit. So like a line of credit, like a loan in their business. So you can see that Woolworths could then have a current ratio less than 1. So this is just this, this idea. So, so maybe less than 1 if they're a market dominator, if they have that strong position in the market, maybe they should be using other people's money, like their suppliers. The quick ratio is an even more strict test than the current ratio because it excludes inventory. So it's kind of making an assumption that what if none of the inventory could sell? What if it is technologically or fashionably obsolete? So the key difference between the two ratios is removing that inventory. So, and that sometimes that's a good assumption because perhaps inventory is sometimes slow to sell. So like, let's say Ferrari gets into financial difficulty. It's very hard to sell the Ferrari cars because they're very high price. So we could make that assumption maybe Ferrari, that they're getting into financial distress. We need to take their inventories out and go, well, can they still cover the current liabilities with the residual of the current assets? So it's a much more strict test. So financial structure, so where does the company get its financing from? Is it and how is it able to sustainably cover that particular financing? Because having a lot of debt could put a company into financial distress because they have to do the principal repayments and the interest expense payments as well. So a lot of our financial structure ratios, they are a reinterpretation or a rejigging of our accounting equation of assets equal to liabilities plus owner's equity. So we're interested in of this funding, how is the company financed, and how are they able to cover those assets, how they're able to cover the liabilities with the assets. So we've got debt to equity ratio. So, how much is external debtors versus our equity. So we've just taken that part of the accounting equation. So of the assets base, how does that compare to all our liabilities? Then leverage. Our leverage ratio is very much here. The one that we use in 1B is more sort of about thinking about the banks, because banks often don't have very much in terms of equity. They have lots of debt financing. So how much of our assets, is there compared to our equity in the base of equity? So that gives us our leverage, and then we can convert that again into like what we call a leverage ratio, just to see, okay, how much is funded by equity, and the missing part is how much is funded by liabilities. So this is really liabilities. So we're recasting our accounting equation here. So here is the ratio list that we give you in 1B. There is a whole universe of ratios out there in the world, but we want to make life a little bit more straightforward. We're just introductory accounting here. So we give you this ratio list. This ratio list is on Moodle as a standalone PDF. This ratio list is going to be in your final exam as a tab. You'll be able to click on it at any time during the exam and bring up the ratios. So there's no need to memorize. We got you covered. And it's open book exam. You can have the ratios open on your desktop or wherever you want them. And also we have the cash flow ratios from last week's lecture as well. We've popped them in here into our ratio list too. So in terms of this slide, what I'm just sort of trying to illustrate here is that we can have share price information like the share price of the company merged in with our accounting numbers. So we can bring the two bits of information together, because a company can trade on a share market at a particular value, a market value, and then that could be compared to our book value, our accounting numbers. So let's have a look. You can see we can bring together that share price information, so number of shares, and give us earnings per share. Then we can have return on equity. We can have return on assets, profitability, coverage. Then we could go the other way and we could go, okay, share price, and then how much earnings per share. So of those, the shareholders, how much earnings per share do they get? We can have the book value. So comparing, what's that equity, what's that book value versus the number of shares and book value per share. We can then have, capital structure, asset turnover, receivables, debtors, inventory turnover, etc. So you can see that we can merge both accounting and finance information, and so market information. So they can be very useful together. And lots of finance students, when they get into their third year, they'll often say, if they haven't done a lot of accounting, that's one of their big regrets, because a lot of what happens in the finance calculations is that they're using underlying accounting numbers. So this is what this slide is saying. Accounting and finance can work together. How's that so far? Put your thumbs up if that's okay. How's that lecture? And pretty good? Understanding? Awesome. Okay, great. And yeah, feel free to type in the chat box any questions that you have. We're now awesome. I'm gonna send you some polls. So make sure you got your poll section open. And these are just to check your understanding. How's it going? This particular one, this first one, I added a little bit extra, so you can take a screenshot if you want. This is just, there is an underlying assumption in this question, and it's, so just for the purposes of this slide, assume the following about these ratios, that let's assume that net profit after tax over total assets is our ROA, but usually in 1B, our ROA ratio is earnings before interest and tax over total assets. So we do that, but for this slide, just for a minute, imagine that net profit after tax is the numerator. And this is a nice little way of showing you that in the real world, ratios are calculated in lots of different ways. So we've got ABC Limited, net profit margin of 20%, asset turnover ratio of 0.5. So which of the following is the company's ROA? So I'm going to send you a poll. Let's have a look. What do you think? We've got 5 saying 0.1. We've got 7 saying 8 now saying 0.4. Okay. So the answer is 0.1. So what we do is we're going to multiply our profit margin, which is net income or net profit after tax, by sales, and then we can multiply it by asset turnover, which is sales divided by total assets. So the sales gets cancelled out, the numerator, the denominator, and so assuming our return on assets is calculated as net profit over total assets, it gets back to 0.1. So 0.2 times 0.5. But as I said in our ratio list, it's earnings before interest and tax over total assets. So this doesn't work, but just you can just assume for this slide that's just how it works. Okay, so let's have a go another one. And I'll send you a poll. So from 2018 to 2019, ABC's current ratio has increased from 1.5 to 3. However, its quick ratio has gone the opposite way. It's decreased from 1 to 0.5. What could have caused these changes? So A, the company holding more cash. B, the company builds up more inventory. C, the company generates more credit sales. So I've launched the poll. Have a look. You can click what do you think the answer is. So we've got 14 saying the company builds up more inventory, and we've got 3 saying the company generates more credit sales. So the answer is the company builds up more inventory, because the key difference, the difference between current ratio and quick ratio is that inventory. So if we are removing it, and that they're going in the opposite direction, it's to do with that inventory component. So they're building more inventory because that's going into making the current ratio increased, but we remove it for the quick ratio. And that's not a good sign, building up your inventory, because it could become obsolete and difficult to sell. Okay. So another little question for you. So which of the following ratios will increase when the company declares dividends? Is it A, debt to equity, B, current ratio, C, debtors turnover? So I've launched the poll for you. Lock in your answer. We've got 12 saying debt to equity. We've got 3 saying debtors turnover. So let's have a look. It's A, debt to equity. And remember also that so they're declaring but not yet paid. So it's important to read the question, make sure, so they haven't done the payment. So they've only done one journal entry, debit retained profits and credit dividends payable. So they have a dividend payable going in, and as a liability. Then they would also have equity retained profits. It's not hitting the current ratio yet because it has not yet been paid for cash. But when it is paid for cash, it's going to go to decrease the current asset, just that current asset part, because the cash is being paid. It's not debtors turnover, because that's our accounts receivable. And remember that our shareholders, everything to do with the shareholders is in equity. So no, not debtors. Okay. So now we're moving into we're going to move into now in a minute our next part of the lecture, So Yang, yes. So yeah, dividend. Oh, well, dividends payable could be a current liability. We don't tend to see dividends payable anymore in Australia because we had a change in the laws where companies can't have a dividend that is owing and payable at balance date. So in our balance sheet, we probably won't see any dividends payable. Yeah, it could be that it's a current liability because it's likely to be payable within a 12-month period. Usually, the dividends are paid within like a 3-month period, something like that. Yeah, so that's correct. So and also, well, if the dividend had been paid, we would close off the dividends payable account because that's the second journal entry is to debit dividends payable and credit cash. So if it's the cash has been paid for the dividend, we're only left with the impact on that on the cash. The dividends payable is closed off. So ratio analysis, though, so this is the last little bit before we go into accounting policy choice. I'm going to briefly touch on the advantages and then the limitations because it's important to understand the advantages and limitations of the tool that we're using. So the ratios, and I've already mentioned quite a few of these as we've been going through, like that they're scale free, they're currency free. But let's have a look. Okay, so yeah, the first one, we can make some nice trends using that accounting statement information, bring together different components, bring together income statement, balance sheet components, bring items across and into different sections of the balance sheet to give us some nice little simple numbers that we can start to analyze and get some trends. We can do that comparison other firms, industries, so that they're scale free. We can compare to industry benchmarks. We can compare with previous periods, just like that. And that common size analysis was really good to find out those trends over time. And also, so ultimately, it can be very good assisting us with our decision making. But let's have a look. Okay, so here's the limitations of ratio analysis. So it does depend on the accounting policy choices that are made. And that's why this lecture we cover accounting policy choices. And so, it's about those estimates, maybe the provisions, how much did we provide? And when we did our revenue expense lecture earlier in the term, you could see that sometimes we're making pretty arbitrary choices. We're doing estimates like depreciation at straight line. It can depend on historical cost versus fair value, i.e. revaluation method. And this can affect our comparison between two different companies as well. Like, so if JB Hi-Fi has their property and plant and equipment and revaluation method versus Harvey Norman has it on the cost method, it's difficult to compare. We have to adjust. We might have to adjust JB Hi-Fi to be on a cost basis to then compare it with Harvey Norman. So we have to consider that. Also over time, so maybe JB Hi-Fi used to use the revaluation method for property, plant, and equipment. Now it's switched to the cost method because property prices are falling. So when we recognize recognition of revenue, recognition of contingent liabilities, there's professional judgment involved. So it could be subject to manipulations. I'm not talking here necessarily about fraud. Fraud is a rare kind of situation, but it could be just window dressing that the manager wants the financial statements to look good. They want to achieve maybe their profit target. So maybe that they've chosen particular presentation or made a change to make the financial statements look better. And so, it could be, there's an old saying, garbage in, garbage out. So if you have bad numbers going in, you can have bad numbers going out. If they've been manipulated or something's been altered, it's going to give you a bad output in your ratios. And also accounting information is historical looking, it's conservative, and it's making an assumption that the past looks like the future. It's not unless you go into some finance calculations of like forecasted future cash flows, you get some more forward-looking information. Accounting looks at the past, the last 6 months, the last 12 months, the last quarter, it doesn't look forward. And yeah, we do make that implicit assumption that the past will look like the future, which we know is not always the case. So we have to understand that those numbers are past numbers, and that's what the ratios are picking up on, the past information. Also, lack of qualitative factors, so what we call non-financial information, which is becoming increasingly important. Things like maybe sustainability. Is the company, sustainable, environmentally responsible? Investors are looking at this information now, trying to make decisions, and ratios doesn't have any of that. Doesn't tell you about sustainability of the company, or even the company culture. There's interestingly, people are starting to look at things like a website called Glassdoor, that its employees, insiders tell you about the culture of the company. Is it a good company to work at, or is there a toxic work culture? So other factors can make an impact as well, and ratios alone can't do that. So now we're going to move into the accounting policy choice section of the lecture, and then we're going to go through, and the last bit of the lecture is looking at some manipulations of profits, like what are the incentives, why is it done? So this slide is a repeat of earlier, and I put an arrow just to remind myself not to go back over this slide. So why do we look at accounting policy choice? It's because those choices impact on ratio analysis, and it can interrupt the interpretation or like comparison of the past versus the current period if a company changes their policy, and also let's say JB Hi-Fi versus Harvey Norman. It can impact how readily we can compare those two sets of ratios. So that's why the accounting policy is important. That's why we're focusing on it in this lecture. So the arrow is just to tell me not to go back through this slide again, which I did earlier in the week. I got all excited and I was like, I'm just going to talk about more stuff. Okay. So accounting policy choice, what is it? What's it about? It's because we have some ability when we're preparing financial statements to choose different options. We could choose some different principles, and we even saw at a higher level that international accounting standards are very principles based versus US GAAP is very rules based. So as soon as you have different guiding principles, it opens up to professional judgment of accountants. So we can see different choices being made versus when something's very rule based. It could be the basis for the calculation. Maybe we have a different view on particular, let's say, property, plant, and equipment. Maybe the base of that calculation should be 10 years, 20 years, and it could be different way that we get to that particular calculation, or what we're trying to analyze and put onto our financial statements. It could be a convention of that particular industry, and the industry that company can then choose to follow the convention of an industry, or they could go against it. So for example, like airlines, so Qantas, they can have this choice of maybe the rest of the airline industry recognizes revenue when the plane takes off, but Qantas might say, no, we're going to recognize revenue when the plane lands with the customer. So they're taking a different choice. You can do convention, or you can do not convention of that, in particular, maybe that example for the industry. It could be that there's rules, and sometimes different countries have different rules. Different countries have different consumer protection laws, which those rules can feed into what happens into the accounting information. So for example, Australia has a rule of warranties of 1 year have to be provided on electrical goods, versus other countries may not have any consumer protection laws. And we can see that it could be past practices that are causing this particular accounting recognition choice, or some sort of, what we're doing. Think back to the equity lecture week when we saw that we would have a general reserve being created, and that was simply because of past practice. The general reserve doesn't necessarily do anything. It just signals, it's been past practice in Australia that it signals that a dividend's not going to be paid out of retained profits. So it's just they're adopting a past practice. So that influences then what is presented in the financial statements. So the choice, it's about how, it's about when, it's about whether we're going to record something. And I'm going to take you through in the next few slides, the methods, the estimates, the recognition and the disclosure. How are these choices impacting our financial statements? And then in turn, they do impact our ratio calculations. So I'm gonna go through all of these different choices. The first of these choices is methods. So methods we have, and I've got three examples, and this is sort of what we're focusing in on in 1B. These particular sort of methods, there are more method choices, but we leave those for second and third year accounting. In particular, if you go on to the third year, ACCT 3563, they go into this policy choice a lot deeper, and interestingly, they're going to have much more disclosure and look into a bit of the research as well, the accounting research there. So if you're interested in this, you'll see more of it if you do an accounting major. So the inventory can be valued in different ways. And so we can have FIFO, and here I can see that we have one choice that's removed. So you can cross this out for Australia. We don't have LIFO. That's not permitted, but in the US they do. So you can see that immediately there's choice. A difference can arise when we're comparing two companies. So just like, let's say Starbucks, we want to compare it with Gloria Jeans. Starbucks has that extra choice available of LIFO that Gloria Jeans does not in Australia. So Gloria Jeans can only value their inventory either at FIFO or weighted average. So we could cross that one out if we want for LIFO for Australia. Then we've got weighted average. That's another choice. So it's important to remember how are we calculating these, and that it's the inputs into these calculations of our inventory or our raw materials that can affect the outcomes. So it could be that we're looking at prices are rising or prices are falling. How's it going to impact when we have our first inventories in, first out? So those higher prices might earlier inventory, higher price might go into cost of goods sold versus the ending inventories going into our ending inventories. But weighted average just averages across. And so you see this in one of the tutorial questions for next week, that all of these are touched on, and how do we interpret if a company wants to go from one to the other method? How's it going to impact our ratios? A company could switch their property, plant, and equipment depreciation. They could go from straight line to reducing balance. And we know certain properties about these different depreciation methods, like reducing balance. We know that at the start of a asset's useful life, it's very high, and then it depreciates almost all of it in the early part of its life. So depreciation is very low by the end, whereas straight line goes straight through the middle. So if they're switching from straight line reducing balance, you can tell what sort of choice, what difference is happening. And also then, if you're comparing Harvey Norman with JB Hi-Fi, then you can go, well, okay, so Harvey Norman uses reducing balance, JB Hi-Fi uses straight line. You could then go, well, okay, I need to recalculate one of them so that they're on the same basis so I can do a comparison. It could be that a company chooses different ways of measure the methods for property, plant, and equipment. Maybe, let's say JB Hi-Fi uses historical cost, whereas like Harvey Norman could use revaluation model. So everything's reported at fair value. So we can work out, okay, maybe we need to convert one of them. And if a company reports under the revaluation method, they need to also put that the cost, if it was under the cost method, in their notes. So we could reverse one of them out to have them on a similar basis. they can change. A company can change over time as well. So we have to then look at, okay, what happened last period, what happened to this period. And in particular, like when property prices are increasing or if they're decreasing, how is that going to impact our assets? And how's that going to impact our income statement potentially if we have a loss on revaluation below its original cost? So accounting estimates is another choice that can be made. And this is sort of getting more into the nitty-gritty of the actual percentage calculations, or, internally the numbers that are used to generate those particular accounting amounts. And this is under our accrual accounting. We're making estimates, and sometimes they're a bit arbitrary. We need these estimates to be able to be disclosed as well. These are disclosed in the note to the financial statements, and then it's on a basis that someone could be able to reverse out those calculations. So it could be bad debts expense, and then allowance for doubtful debts as well. Our estimation provision we could change it from 5%, increase it to 10% of sales. And you can see here that then it's going to hit the income statement with the bad debts expense. It's going to hit the balance sheet with allowance for doubtful debts. So, it's going to increase expense. It's going to increase that contra asset, allowance for doubtful debts, decreases net receivables, and decreases total assets. What about if they switched for their machines from a 10-year useful life to a 20-year useful life? So they're going to spread out the depreciation over a longer period. So it decreases it. If we were to assume it's straight line depreciation, it would definitely decrease it, the amount per period. Once again, dual impact. Depreciation expense on the income statement affecting net profit. It's going to hit the balance sheet as well. Our accumulated depreciation, which is netted off in our assets to have a change in our total assets. Provision for warranty as well. So 10% of sales, or maybe they could switch to 10% of cost of goods sold, or it could be a mix. If you remember back to the liabilities lecture, so it could be that maybe some of the goods are returned, they get the sales revenue, the cash back, or it could be they do an exchange of inventories. So they could use a mix of the both. Sometimes companies under provide for warranty, but ultimately they end up having to debit more warranty expense down the track. And also whether they provide for a warranty at all, so some companies like Apple operates in many different countries. So a country like Australia, they'd have to have that 1-year warranty provision, whereas other countries, or let's say the European Union, let's say they had a 3-year warranty. So they're going to be providing for warranty differently across different countries potentially. So it could be the recognition. So it could be that an event or a transaction when is it recognized, if it's recognized. So going back to research and development. So it's quite interesting. Companies in Australia have that choice. They have that choice of being able to capitalize development. And whereas in the US, both the research and the development components must be expensed in that year. So you're going to see a difference between US financial statements with research and development expensed versus Australian financial statements prepared under international accounting standards, where development could be capitalized. And I got quite interested in this a couple of years ago. I had an idea I might do some research. I was interested, do Australian companies capitalize? So because I had a prior idea of, I thought, okay, that they have this ability to capitalize development, they must be capitalizing development surely, because don't they want it on their balance sheet? Don't they want it to have it as an asset? There's so many reasons why they want to increase net profit potentially and have it removed out of expenses. So what I did was I looked up 100 Australian company annual reports, and I looked in their financial statements, and I looked what were they doing with development. And interestingly, the majority of those companies I looked at were actually expensing development. I was a bit surprised. I thought, oh, why is that happening? And then I talked to various people at companies, and I talked to accounting standard setters, and I was very interested. I was like, why is this happening? Because we know that they may capitalize. Why aren't they taking that option? And from all those discussions, I came up with a number of reasons for why Australian companies may not capitalize. So one of them was that the ratios can look better. So, for example, return on assets could look better. So, not in that initial year, because they're taking the expense of writing off development, but in subsequent years, return on assets could look better because you have profits in the numerator that are not coming from assets in the denominator. They've written off the development. That's one potential reason. Another potential reason is because they do have US investors, or they're cross-listed into the US. So it makes much more sense for them to just expense off of that development, to not have it on the balance sheet, because it might confuse the investors. So that's another option. It could be also that that development is assumed to not have too many years of being useful. So it could be that maybe the development's only useful for 2 years, so they end up writing it off anyway in the second year. They end up amortizing it over 2 years. Mokis has asked, could another reason be lower income tax? Yeah, it could be. So that in the year that they take that, they write off the development, yeah, it'll lower net profit, which will in turn lower the tax that's paid. So it could be, and it could be that maybe a particular year they get some favorable, a lower tax rate, something like that. They might want to take advantage of that. So it's just interesting that you can make an assumption that companies always capitalize, but they don't necessarily do that. Just because they can, they don't not necessarily taking that option. And you'll see this when you do the tutorial questions for next week. We have one question about research and development, and we ask you, what if that company no longer capitalizes the development? What does it look like? And also we ask you something that which is maybe not a good option, is that they want to capitalize their research. And in that tutorial question, we're interested in what your opinion, what your reasoning based on what you've learned so far, what you know about assets, based on all your knowledge, why is capitalizing research not a good idea? Why does it not meet the asset test? So be able to do that for next week's tutorial question. But the opposite, capitalize on or expense that development, that's an option. Companies have an option there. So recognition of revenue. So if you think back to the revenue lecture week, companies had different points in time in which they can recognize revenue. They could do it. They could wait until the cash is received, or they could recognize when the products are delivered. So remember, there's different points. There's where the risks and rewards are transferred, and there's some professional judgment involved in making that decision at what point in time revenue is recognized. And we talked about also, like, new companies are coming in the market that could, they could absorb that risk. So it could be that, let's say you've got McDonald's, that they sell a hamburger, Uber Eats comes and picks it up. So they're transferring the risk and rewards to Uber Eats, who then takes that hamburger to the customer. So it could be that they then recognize a point of sale, regardless of whether the burger gets to the customer or not, because it's up to Uber Eats to then sort out the refund. They have that risk and rewards being transferred to them. So it could be the disclosure itself could be a choice that they make. So companies in Australia, the majority report their income statement and the cost of sales. So that's a convention of what most Australian companies do, but companies could choose a different method of disclosure. They could do that by function. Remember back when we did look at revenues, expenses, and we looked at the income statement, the by function is very different in terms of what it shows. So it might prevent someone from comparing across two companies. If one's like the cost of sales, which is revenue minus cost of sales, then minus your admin and other, versus the by nature, which is where you classify all your expenses into what they do. So depreciation, salaries, doesn't matter where it's from in the business. So this can be a barrier to comparison, and a company might be deliberately choosing a different way of presenting so that it's difficult to do a comparison. It's difficult to interpret. The level of detail in the notes as well could be different between, let's say, JB Hi-Fi and Harvey Norman. They could put different information, which could make it difficult to compare. Also across different countries. Like I've looked at various different countries. I've looked at the notes, and it can be quite different in terms of what they have to present, and then it can make difficulties in comparison. Interestingly, also, companies, as we saw in the previous 2 weeks when we looked at cash flows, companies could put items like depreciation expense inside of other expenses on the income statement. And we're starting to understand in accounting research that sometimes companies actually will maybe hide some information inside of other expenses on the income statement. So for example, there's a research paper that looked at, is research and development a line on the income statement? And for a lot of companies where it's kind of expected that you would see that research and development as a line, as an expense in the US, you don't see it. So for example, Apple, maybe if you don't see research and development as a line, does that mean that they don't have research and development? No, because they could have lots of patents. So it could be companies are concealing it. Think about why would their managers want to do that? It's so that Samsung, their competitor, can't see how much Apple is investing each year on research and development. They can't get a competitive advantage. So it could be that selective line item disclosure, hiding things in other expenses, because we know that unsophisticated users of financial statements, they don't really go to the notes. They're relying on the income statement. They're not digging into that detail to find out where is maybe the depreciation or the research and development. So it could be how much information they disclose about a contingent liability. It could be, there's professional judgment about whether the contingent liability should be reported in the notes, because it's that probable test. Is it probable? But there's professional judgment involved. So are we going to see the contingent liability being reported or not? And how much information about it? So why is there a choice? And sometimes students, when I do this lecture, will go, I don't think there should be a choice. Why is there a choice? It's bad. Well, there's a lot of reasons why we do see choices. Let's go through some of them. So the first one is accounting standards can't be so complex and detailed that they have every single rule. They can't ever envisage all possible transactions. So there's new transactions, there's new ways of doing things all the time. And they're already very complicated and very detailed. So because we can't cover everything, we have to allow some choices to be made. Also, we need to allow accountants to have some flexibility to make some choices that reflect that particular firm and in particular industries. So different industries exist. We have to cater to all of them. We can't have accounting standards for each industry. So typically we have to have some different choices. So we saw in our revenues and expense week that for long-term construction project companies, we needed to have that choice of the percentage of completion. So because otherwise they could never recognize any revenue as they constructed the project. So different industries, we need to have different choices. So, but the downside is Yes, with all this choice, there's potential for managers to maybe manipulate, try and make the financial statements look better. So there is a downside to choice. So so in the absence of any guidance of an accounting standard, what do we do? So we need to look at maybe there's some other accounting standards that are applicable to that particular item or transaction. Let's say I'm trying to record Bitcoin. I want to record that in the financial statements of a company. They started to transact in Bitcoin. I have to hold this Bitcoin up and kind of go, well, is it behaving like cash, or is it like a store of value? What's it about? And if there's no accounting standard that I think that applies, maybe I need to just find something that's a relevant and reliable measurement. It could be maybe other accounting standards with similar items. So Bitcoin, I might look at the assets. I might look at maybe it's like cash. It could be I need to go to the framework, back to the definition recognition criteria of assets. And then I might need to think about, okay, is this Bitcoin an asset? Does it meet the asset definition? So it could be that, extra information might help me. So the standard setters sometimes put out, some guidance, particularly if the big four accounting firms, let's say Ernst & Young goes, I want to know, how do I deal with Bitcoin? Then perhaps the accounting standards setters would then go, here's a guidance document about accounting for Bitcoin. So it could be accounting literature, so accounting research, maybe a research paper might have just been published about Bitcoin, so they could rely on that. Or it could just be industry practice. So another company that they know about has recorded Bitcoin and they've recorded it as just like cash. So this is how they're going to adopt and do that kind of accounting. So there are constraints. So companies can't just willy-nilly change whenever they feel like it. They need to be constrained. They can't change too often. And the standard setters make it quite onerous when they do make a change to kind of prevent them from just making a change whenever they feel like it. So it could be that the company needs to select and apply, to similar transaction events and conditions. They can't just make things different. So a particular class of asset has to be accounted for in the same way. Every time they make a sale, they have to do it. They have to recognize it that same way. The company can only change if, let's say, there's a new accounting standard, like there's a new standard for leases, there's a new standard, recently revenue recognition. So I have to say, okay, there's a new accounting standard, we're changing the way that the policy is done, or that is more reliable and relevant because of that, the new choice. And they have to often explain, put in a paragraph, why is that important? What's that change about? And they need to disclose it sometimes, so that paragraph, why they're doing it. Also, they could have to retrospectively apply the change, like for the last 2 or sometimes 5 years, show the change. How does it affect the numbers? So when we look at disclosures in the notes to the financial statements, note number 1 is our significant accounting policies for Australian companies. They're going to show which policies are very significant for them. Then often note number 2 is any changes. Maybe, for the new leasing standard, they'll talk about how that change comes through. It could be then, if they do a change, the nature and the reasons and the financial effects, so that retrospective change may be needed to be disclosed. Here's Woolworths 2007. So you can see some of the information. So significant policy, they talk about property, plant and equipment, how they account for it. So freehold land and buildings, lower of costs, less accumulated depreciation. So they're using the cost method, land and buildings. That sounds like the fair value method because it's lower of cost and fair value, less cost to sell. So fair value being revaluation method. Then the buildings, they have to give the number of years of their useful life, and we can work out that this is straight line. So we can pick up all that information. So let's have a look and try and look at some of the effect of the changes. So one important effect that you need to be aware of is that the cash flows are often not affected until a subsequent, so the next year, because these kind of adjustments are really for accrual, often accrual entries that we're talking about, so our revenues, expenses, and it may just be indirect effect on tax. And in Australia, a company reports how much tax is owing based on a profit, but then pays the tax to the tax office the next period. So the cash flow happens in the next period if the tax is changed because the profit is changed. Also, there's that dual effect on both the income statement and the balance sheet. And there are some trade-offs. So just pulling revenue from next period into this period, it decreases next period. Or it could be you push expenses into the next period. They're still going to be there. They're just in that next period. So here's just some summary of like that dual effect on the balance sheet and the income statement. I've sort of talked through a lot of these as I've gone through. So you can expect to see those two impacts happening. So let's say if we wanted to switch from straight line to reducing balance, there's 100,000 more depreciation that's going to happen. Let's assume a tax rate of 36%. So what's the impact? So we can see once again that dual effect, depreciation expense, accumulated depreciation, income tax and income tax payable because the profit's different. And so I can just walk you through. So expenses will be higher, 100,000, profit lower, 100,000. The tax, that change, so based on 36%, so 36,000 lower because of lower net profit. Overall, net profit decreases by 64,000, so net of that tax effect. So overall, profit lower 64,000. So then the balance sheet, accumulated depreciation is higher, 100,000, lower total assets, 100,000. The tax impact, less liabilities, 36,000. Equity, when we put the net profit in, lower by 64,000. So cash, this year, no impact. Next year, yes, there'll be a lower cash outflow, and there could be reasons why a company wants to minimize their profit because they could minimize their tax. They could also get reduced exposure, so maybe like employees, the labor unions, they might be looking and they're like, oh, this company's making a lot of profit, they should increase the wages of the employees. So manipulation, let's get to this bit. So yeah, so higher profits, you can think of lots of incentives for that. That's a more natural idea. They want to meet market expectations, analyst expectations. They want to meet their bonuses, often based on net profit. It could be they doing an initial public offering, some share raising. They want to look good. Lower the profit, get out of the spotlight, reduce visibility. Could be they're trying to do a big bar strategy. So about 5 years ago, Qantas wasn't doing so well. They knew the CEO, the managers knew they're going to make a loss. So they were like, let's just pile on. Let's do lots of write-offs. Let's write down our inventory. Let's just do all of that. And so they made a small profit into a bigger profit at that stage. And then they cleaned up so that they could look a lot healthier in maybe in the subsequent periods. It could be also when there's a new CEO, they might try and blame it on the old CEO. Debt covenants as well, managing around those thresholds. They don't want to go over the debt to equity ratio maximum and breach the debt covenant. They don't want to have that the bond become all due and payable in 1 year. So I'm going to send you a couple of polls before we finish off this lecture. Let's have a look. Okay. What if ABC Limited decides to depreciate their machinery over 30 years rather than 10 years? Let's assume straight line. So we've got 14 saying profit increases, 2 saying profit decreases, 1 saying no change. So its answer is yes, A. So stretch it over a longer period. decreases the expense, increases the profit. And a real company did this. Waste Management Inc. overstated by 1.7 billion profits. They put them under realistic estimates, and they would have gotten in trouble by the US SEC regulator. So next, I'll send you another poll. What do you think about this one? So what would happen if ABC Limited decides to recognize unearned revenue as revenue this year that should belong to next year? So what do you think? Yeah, pretty much everyone's correct. Revenue increases, we have 15 saying revenue increases. So, yep, they're just going to pull it into this period. They're going to have more revenue this period. And Panasonic did this. They overstated their revenue by 82 million back in 2012 by doing that, pulling it into this period. So another question. So what would happen if ABC Limited decides to value their assets at historical cost instead of fair value, where asset prices are falling? So we've got a bit more variation on this one. So we've got 12 saying the profit increases, asset increases. We've got 3 saying profit decreases, asset increase, and we've got 1 saying no change. Let's have a look. Profit will increase because if we're revaluing downwards, we're possible to get, we're going to have the loss on revaluation, and our assets are in comparison are increased because we're not having to reduce down our assets. And so Olympus did this, covered up 1.7 billion of financial instruments by switching to historical costs instead of being under the revaluation method. Okay, one last question. I know we're running a little bit short on time. So, lucky last question. What would happen if ABC Limited decides to capitalize operating expenses, such as maintenance costs, as assets rather than to expense them? So what do you think? Just lock in your answer. So it looks like pretty much everyone's got that right. So yeah, profit increases, asset increase. And WorldCom did this. It was one of those big corporate collapses. They capitalized 3 billion of operating expenses in 2001 to 2002. So very naughty of them. That's very bad. Because you shouldn't. You shouldn't. They should be expensed. So a little joke here. So Brian used to be a magician. He's now their financial accountant. He can magic away unpleasant liabilities, produce assets that didn't exist. So creative accounting is very naughty. We shouldn't do it. And that's just what this is sort of saying. It's not good. So sometimes, and mostly, it's just like managers trying to make the financial statements look better, but it can get into what we call maybe aggressive accounting or creative accounting, which is not good, and the regulators will catch up and find that out. So that's the end of the lecture this week, and I'll see you next week. If you have questions, you can just ask me in the chat box. Otherwise, see you next week for management accounting. Bye. Have a good day. Bye. See ya. Have fun. See you next week. Bye. Bye, everyone. Hey, Mike. Bye, everyone. Oh yeah, I can ask. You can ask some questions. Oh, is it double pass? No, not double pass. So yeah, it's just overall. If you get 50% in the course, that's okay. Yeah. So Mike, because there's 50% of the assessment going into the final. So yeah, if you get all your self-check quizzes done, you get all of your so your class quiz marks, you got 50%. Yeah, so you can pass the course. Yeah, you don't have to do the final. That's fine. Well, you should do the final because I think it is very hard. There's a lot of variation on the quizzes, and also a lot of students I notice haven't been doing the self-check quizzes, which is a bit naughty. Like in terms of if you leave it all for week 10 and you get under pressure, then you might run into problems. Which I'm surprised. I was looking in the grades the other day. I was like, ooh, some students leaving it to the end. Yeah, Mike, that's right. Yeah, self-check quiz, you just attempt it. They're all worth 2.5% if you do them. Surprisingly, some students are not doing them. There you go. Any other questions? Yeah, so okay, yeah, Hannah. So the big bath. Yeah, so it's it's to do with, so if let's say it's Qantas. Let's say they know they're going to make like a $10 million loss in that period. Then it means that the CEO doesn't get his bonus. The managers don't get bonuses. So then they might start to look at, okay, what other things can we do to, like make next year look better? So uh, they might try and like write things off, or they might do extra expenses because they already know they're in a loss and they're not able to get into a better position. So they make it a big loss. But if they've incurred some expenditure that was supposed to be next year, they make next year's profit look better. So it's about, okay, this period we don't think we're gonna make it, so let's throw everything in bad so that next period looks better. And you can see that Qantas, they do have that pattern. I'm not saying that they necessarily did it, but yeah, they're like, oh, we're making a loss. Let's get rid of a lot of stuff. And then next year they look really good. So yeah, so does that make sense? And also like a new CEO, because they're like, I can blame everything on the last CEO. This is bad. Let's get rid of this, and then next year is great. And that's the new CEO, what they've done. Um, so Yang, are we supposed to get questions like the effect of change examples in the slides and work out the different? Yes, that's what this topic is about, and you'll see that in the tutorial questions. So about the changes, so there's no calculations really, not much calculations. It's more understanding and interpreting, writing that information, communicating that story of what's happening. Yeah. Sometimes you can use calculation to help yourself kind of work out what does that trend look like. But ultimately, we want the words. We want you to explain it, because a lot of accounting is about communicating and explaining it. Yeah. Any other questions? No. Okay. We'll see you next week. If that's all, see you next week. Bye.